go ahead and begin. Well, good morning, everyone. Welcome to the first session of the Opportunity Zones 2.0 informational webinar series for the state of California. My name is Brian Coleman, and I am the Project Financing Manager with the Regional Economic Development Initiatives team at the Governor's Office of Business and Economic Development. We truly appreciate you taking the time to join us as we kick off this OC 2.0 selection process, which will ultimately result in the state nominating census tracts across California for Opportunity Zone designation. The work that we are undertaking will have a tremendous influence over where and how private capital will be deployed within the state over the coming decade. And so your involvement and input throughout this process is truly appreciated and will have a major impact over the prosperity of your communities in the coming decade. The primary purpose of these informational webinars is to provide timely and relevant information related to the OC 2.0 selection process. And we hope that you come away with a better understanding of how the Opportunity Zone program works and how it can be leveraged to accomplish a wide range of economic development objectives in your communities. So to help accomplish this, we have lined up a tremendous group of expert speakers to share insights about opportunity zones, as well as highlight best practices for identifying the most strategic census tracts within your jurisdictions for OC 2.0 recommendations. And then ultimately, we hope that the information that is shared today will help you position and market those tracts for future investment if they receive a designation. But before we get started with introducing today's speakers, there are a couple of quick housekeeping notes that we need to go over. Audio and chat features have been deactivated for all attendees to ensure no disruption in the flow of agenda. If you have any questions for the individual speakers, you're encouraged to use the Q&A function at the bottom of your screens, and our speakers will respond to them in order when they are done with their presentations. Also, as a reminder, the GO-Biz team will not be responding directly to questions from the Q&A during today's session. All questions will be reviewed by our team after the webinar and will be included in the FAQ that will be posted to the GO-Biz website. We will also be sharing a link in the chat to a web form where you can post questions for our team. The web form will remain available after the webinar for any additional questions or follow-up content, so it will be up on our website even after the webinar. And then as a reminder, today's session is being recorded, and both today's session and all future sessions will be posted to the GO-Biz YouTube channel for later viewing. All right, so here is an overview of the agenda for today's session. We will first hear a presentation from Kevin Wilson, who is a partner at Novogradac, which is one of the nation's leading consulting firms specializing in opportunity zones. Kevin is based in Novogradac's Walnut Creek office, and he will be providing an overview of how the OC program works, as well as discussing recent updates to the program following the passage of the One Big Beautiful Bill Act last year. And then following his presentation, we will hear from Kenan Fikri, who is the Senior Fellow at the Economic Innovation Group, or EIG. EIG is a bipartisan think tank that helped develop the original Opportunity Zone concept. And Kenan will be sharing insights and best practices on how local leaders can collaborate to identify the most strategic census tracts for recommendations in their jurisdictions. And then after Kevin and Kenan conclude their presentations, I will wrap up the webinar by providing a high-level overview of how the state anticipates selecting census tracts for OC 2.0 nominations. And we will also be sharing information on how local jurisdictions can participate in recommending census tracts to our office for potential nomination to the U.S. Treasury. Okay, so with that, I'll go ahead and pass it over to Kevin, who will give his presentation or overview on how the Opportunity Zone program works. So Kevin, the
Great.
floor is
Yeah,
yours.
thanks, Brian. Hi, everyone. Happy to be here. I am Kevin Wilson. I'm a CPA with Novogradac. Novogradac is a national accounting firm headquartered here in California with a strong expertise in a variety of community development tax incentives. I'm also based here in California, California native. I grew up in Southern California, went to college in Central California, and have been in the Bay Area ever since. Um, so at Novogradac, as accountants, we work with clients and policymakers to help identify ways to leverage the tax code and other resources to efficiently and effectively support good causes. I've been doing this for over 25 years now, and throughout that time, I've been focused extensively on working in affordable housing and with nonprofits. And I've been involved with opportunity zones since prior to its enactment as a relatively small part of the large Tax Cut and Jobs Act that was passed back in 2017. So while the incentive was enacted as part of a partisan budget reconciliation process, both back in 2017 and also with the changes that were enacted this past summer, I think it's important to keep in mind that the incentive is rooted in bipartisan legislation that was introduced in the Senate by Senators Tim Scott and Cory Booker. Let's go to the next slide, Brian. So to get us started here today, what I'm going to do here is I just kind of want to start by laying out some groundwork and context and background information about the Opportunity Zones tax incentive. And I'm going to start by providing a high-level overview of what the tax incentive is. But, as is often the case with tax laws, things can tend to get complicated or confusing. But I still think it's important that we all have a foundational understanding of what we're going to be focused on today and over the next couple of months as we work on this important process of figuring out where California's newly designated opportunity zones will be. So I'll try to keep this overview simplified and relevant to the purpose of today's discussion. But as with anything tax related, there will surely be questions. So please feel free to use the Zoom platform to reach out, and we'll try to clarify those as best we can. So as originally enacted back in 2017, the Opportunity Zone incentive was a temporary part of the tax code. And the original zones that were selected at that time will expire at the end of 2028. But then this past summer, as also a relatively small part of a massive budget reconciliation bill, the multi-trillion-dollar tax reform bill known as the One Big Beautiful Bill Act, the Opportunity Zone incentive was renewed and enhanced in a number of ways. So some of the key changes and enhancement to the incentive are, so for one thing, the incentive, it was made a permanent part of the tax code. So whereas originally it was going to expire soon based on fixed dates in the tax code, now there's just kind of this, it's permanently part of the tax code. And the process that we're going to be going through this summer of designating zones, that's set to reoccur every 10 years. And then also the deferral mechanism that's kind of the gateway for the opportunity zone was simplified. So now there's just kind of a 5-year, what we're calling a rolling deferral period. And There were also certain enhancements that were added to incentivize activities in rural areas, such as, which we'll talk a little bit more about that in a little bit, but kind of the big ones there are a larger deferred gain forgiveness and a lower substantial improvement threshold for property that's in rural areas. Um, Also, this is going to be an important part of what we're going to be talking about today. The opportunity zone eligibility criteria was narrowed. So this significantly reduces the number of eligible tracts. And then another big one, another big change here is that reporting requirements were added. So this is going to add transparency and meaningful data gathering to help assess the effectiveness and shape future improvements to the policy. Let's go to the next slide, Brian. So the Opportunity Zone incentive at its core, it's a federal income tax incentive. So the statutory authority is derived from the Internal Revenue Code, which is why as a tax accountant, I'm here today to help. So it's a place-based incentive that's designed to reward the deployment of patient idle capital to make transformative investments into distressed communities. So investors that make qualified investments in qualified property receive a deferral and potentially forgiveness of capital gains taxes if those investments meet certain criteria. And capital gains, just for background, just to set the table here, are essentially income that's derived from the sale of appreciated assets like stocks or real estate. And having a capital gain that can be deferred is a gateway. Also, not having is a potential barrier for investors that are seeking to utilize the tax incentive. So investors whose income is derived solely from wages or self-employment income generally won't be able to benefit from the opportunity zone incentives as presently enacted if they don't have the capital gains that can be deferred upon initial investment. So really what we're showing here on the screen is that the opportunity zone incentive is essentially rooted in three key tax benefits that the investors will be eligible for. The first one, as I just mentioned, is a gain deferral. And under the Opportunity Zone 2.0 statute, that gain deferral is for a 5-year period. Under Opportunity Zones 1.0, it was basically until the end of this year, right? Um, and then, so that's the first benefit is that gain deferral. The second is we call that partial forgiveness. So again, it's a temporary deferral, and then when that gain is recognized, in the case of Opportunity Zones 2.0, after 5 years, a portion of that won't be taxed. That portion now uh, will vary whether the investment is in a rural area or not, with rural investments getting a significantly larger step up or partial forgiveness. Uh, and then the third benefit is forgiveness of additional gains. So this is oftentimes the incentive that kind of grabs the headlines, right? Uh, and basically, the way that this works is if the investment maintains compliance requirements for at least 10 years, then after that 10-year hold period, any new gains realized by the investor could be tax-free. Let's go to the next slide, Brian. So this is typically put together under what I refer to as a two-tier structure, where the investors that have capital gains that can be deferred invest in a qualified opportunity fund or QOF, which I call the upper tier. And the QOF then invests in a qualified opportunity zone business or QOZB, which I call the lower tier, right? And so it's this lower tier qualified opportunity zone business that owns and operates some kind of business in the distressed community. In general, for these investments to be qualified, a substantial investment of capital must be made in this distressed community. And I believe Ken will be sharing some pretty good examples of what this has looked like so far based on the investments that have already been made under Opportunity Zones 1.0. So I mentioned that it's a federal tax incentive. I also want to note that many states also provide a parallel income tax incentive for state income taxes. And some states and communities provide additional enhancements to attract capital to their distressed communities. Let's go to the next slide, Brian. So that's the high level overview of the tax incentive. But again, I think the focus here today is where are these zones going to be, right? So now I just wanted to set that background because we continue to get tons of questions on it. We can spend all day talking about that, but I just wanted to use that to set the table here. But now we can start talking about the zones and what are the zones, right? So an opportunity zone is a census tract, right? And it's a census tract that is by definition a low income community and that is designated as an opportunity zone with the authority to nominate such tracts given to the governor of each state through the tax code. So an opportunity zone is a census tract that meets that definition of a low income community and that is designated um, as an opportunity zone by the state. And so we have here the definition of what the low income community is, and then the state is authorized to take 25% of the census tracts that meet this definition and nominate those as opportunity zones. So the kind of the key criteria for whether or not a census tract is eligible or not is either you have median family income in that census tract that is at 70% or less, or you have a poverty rate of at least 20% with a median family income of 125% or less. Let's go to the next slide, Brian. So this definition changed this past summer. So the eligibility criteria that we're using this time around are quite a bit different than the eligibility criteria that was used back in 2018. Um, so as a result of that, the number of census tracts that will be eligible is significantly less. It's been calculated. I don't remember the exact number, but I believe it's 20 to 25% less census tracts will be eligible this time around. So let's go to the next slide, Brian. And so this opportunity zone designation process that will be getting a lot of attention over the next several months. It's governed by Internal Revenue Code Section 1400Z1. And the reason for the heightened focus over the next several months is because, per the tax code, starting on July 1st, states will have 90 days to submit nominations to Treasury. And then once Treasury certifies these new opportunity zone designations, they'll take effect January 1st and they'll remain in effect for the next 10 years. And then 10 years from now, if the tax code stays the way it is, we'll begin this process again. So the current opportunity zone 1.0 zones will, as I mentioned earlier, they'll still be in effect through 2028. And some of those original opportunity zones will surely be redesignated as opportunity zones and retain that status for the next 10 years, while other current Opportunity Zone 1.0 zones might not be eligible under this new criteria. Or even if they remain eligible, perhaps other tracks may be selected instead. A few weeks ago, the IRS published Revenue Procedure 2026-14, which, among other things, it provides a list of census tracts that will be eligible under this new criteria. So I want to note that while we have that list, and that's a good starting point, concerns have been raised about some of the data that was used to generate that list. So, for example, the list excludes certain census tracts that don't have population data, or because of the margin of error that's identified with the median family income figures, there is evidence that suggests that some of those tracts that are not on the list might still meet the statutory eligibility criteria. Several stakeholders, such as our Opportunity Zones Working Group, have submitted letters to Treasury and the CDFI Fund to raise awareness of this concern and provide suggestions as to how the states could potentially proceed with nominating zones that didn't make it on that published list in the revenue procedure. Let's go to the next slide, Brian. So I've kind of mentioned this a couple times already because it's pretty important, but I want to take a little bit of time here to talk about some of these new rural incentives. So basically, under the new Opportunity Zones 2.0 statute, with the rolling deferral, investors will generally be able to, for partial forgiveness of their deferred gain after 5 years of 10% if it's not in a rural area. But if their investment is in a rural area, then instead of not being taxed on 10% of that 5 years from now, or 5 years after whenever they make the investment, starting January 1st, 2027, 30% would not be subject to tax. So that's a pretty significant benefit. It was intended to drive more capital to these rural areas. Also, there's this, I mentioned earlier, one of the compliance requirements is you have to bring substantial investment to this community, right? And one of the ways that the tax code measures that is what we call the substantial improvement threshold. And one of the ways that the Opportunity Zones 2.0 statute changed to benefit rural areas is that substantial improvement threshold was basically cut in half for property in rural areas. Let's go to the next slide, Brian. So, so with this added significance of rural investments and rural areas, I want to clarify how the tax code defines a rural area in this context. So this is the definition on the slide, but basically a rural area is any area other than a city or town with a population of more than 50,000 inhabitants, and any urbanized area contiguous and adjacent to a city or town that has a population of greater than 50,000 inhabitants. So that's a key definition. Can we go to the next slide, Brian? So we have on our website we have a mapping tool. It's a free resource there to use as a reference, and we identify the tracts that are eligible, basically the tracts that were on that list that was published by the IRS, and we use kind of color shading to show which tracts meet this rural definition and which don't. So here, if you look at this a screenshot here, the green areas meet the rural definition, whereas the purple areas do not, right? But they're still eligible. So um, let's go to the next slide, Brian. Okay, yeah. So the last thing that I wanted to touch on here before I hand things over to Kenan is I also wanted to emphasize that another key change that was enacted under 2.0 is reporting requirements. So this is something that had been sought after, but was unfortunately left out of the 1.0 legislation due primarily to how the budget reconciliation rules work. And then let's go to the next slide, Brian. But so, these newly enacted reporting requirements will establish a robust new reporting and transparency requirements for funds and investors, and directs Treasury to publish annual reports to Congress on OZ investment activity and outcomes, including data on location, volume, and impact. Um, and so that's what I had today. And so I guess now I'd like to kind of transition it over to Kenan, and please feel free to start layering in questions if you haven't already, and I'll start to go through those here as we have time.
Yeah, thanks so much, Kevin and Brian and the team in California. It's great to be with you today too, calling in from Washington, D.C. So just envious of your California lifestyles, but very happy to share perspectives that we have to offer from EIG, a think tank that specializes in economic development. That has worked closely around opportunity zones, for more than a decade now. So it's my pleasure and privilege to kind of share insights on what makes for a good census tract from the community perspective, based on what we know about OZs so far, and also start to get people thinking, how else can you engage for the next decade during which these OZ designations are going to be active in order to help translate this, capital gains tax incentive into local community impact. So next slide, please. So to refresh, just why do OZs matter? It's the answer is because they are bringing capital to communities. The U.S. Treasury Department, the best available data that they have suggests that about $100 billion in direct, OZ equity capital, those realized capital gains that Kevin talked about, have been invested through qualified opportunity funds since OZs first became law, and then this equity is accompanied by debt, by grant money, by lots of other different sources of capital too. So we're talking about a very large sum of investment here being leveraged through the OZ tax incentives. Such that best available data suggests that 3/4 of all designated census tracts from the last round, those designated in 2018, have received investment and seen at least some OZ investment through the incentive. And one measure of impact that's had on the ground is that in the data we can see that the rate of growth in housing units has about doubled in opportunity zone census tracts since designation, if you look across the whole map. So it's really had significant impact on designated communities, and there especially on the housing supply, which is, there's a housing crisis and affordability crisis facing almost every community in the United States today. So that's particularly interesting and nice to see. Next slide, please. Now, where's that money come to ground? So unfortunately, because of the lack of data and reporting that Kevin mentioned, we don't have much reliable government data to go off of. But with what has been published through the end of 2022, down at the state level, we can see that in the first 5 years of the OZ policy, $9.5 billion has been invested, had been invested in California opportunity zones, and that puts the state in per capita terms kind of right in line with the national average. And that's just a baseline, the amount of capital that is flowing, and that California is right there attracting OZ capital and deploying it just on par with other parts of the country. Next slide, please. So what's it to kind of start to make it tangible? What does this look like in action? This is just one glimpse in one corner of the country, but OZs are, it's a marginal tax incentive at the end of the day, but it seems really good at taking parcels that look like this, vacant, brownfield or dilapidated or generally underutilized parcels, and then transforming them into a new economic activity. If you'll go to the next slide. So taking parcels that look like that to next slide, please. Yeah, to something that doesn't always look like this, but this is the example there from farther north on the West Coast from Spokane, Washington, of just infill development and turning in this case what had been underutilized lands on the periphery of downtown into mixed-use affordable housing development with ground-level retail. That's kind of the mean, median, and modal case of OZs in action, and they're very good at that. But next slide. And again, to show another case of OZs in action on the housing front, this chart depicts just the rate of increase in number of addresses in opportunity zone tracts, which is the dark line, and non-opportunity zone census tracts, which is the light line nationwide. You can see that before OZ designations back in 2017, 2018, opportunity zones trailed all other census tracts nationally each year with the rate of growth in new housing units. But they caught up soon after OZ designations started to hit the bloodstream and now have overtaken and surpassed other non-opportunity zone tracts in general with the rate of increase in new housing units. So this shows the incentive really can move capital and can start to move the dial on development patterns in communities. Next slide, please. So why should you care about opportunity zones, about this capital gains tax incentive? So for a couple of reasons, really. Several reasons. One, it can help close deals and get good projects off the ground. Often that equity capital is kind of the scarcest and hardest to come by slice of, the project financing capital stack, as it's called, to get a good, high impacts or meaningful project over the finish line. And OZs, bring more investors with more money to the table, looking for more deals and good projects in designated communities. They can also, as I mentioned, drive infill development and complete the neighborhood fabric. So just getting kind of better use out of your space and helping complete streets, helping to complete neighborhoods and bring and restore economic activity to even down to the partial level parts of your community that it's left. They can also be effective on, mobilizing a bit of a local vesting or reinvestment ecosystem locally, where I've seen a lot of high impact and really good community outcomes flow through the OZ incentive. It's been where, local investors who are committed to the prosperity of their community see another reason to, with the OZ tax incentives, invest in doing well or doing good by doing well in their local communities. So the OZ incentive is a nice kind of federal boost to this kind of nascent corner of impact investing. They can directly address housing shortages at all price levels. It's a buy right incentive, and the federal government doesn't really pick and choose what projects OZ will receive OZ treatment, and that means that some folks are going to use it for market rate housing, some for workforce housing, some for affordable housing, and indeed we see that OZ's working housing supply at all price points. These boosted rural incentives that Kevin talked about should be powerful enough to help spark economic development. I think, by that, I mean, helping, expand manufacturing footprints or industrial and commercial activities, especially in rural areas. And then, use OZ designation to put more power and private capital behind plans that you already have. Maybe you have priority development districts, main streets that you want to help, guide private capital towards, or other long-term development, transit-oriented development master plans, et cetera, where it can make a lot of sense to layer on an OZ incentive to help make sure that private capital shows up to help realize and increase your return on your public investments. Next slide, please. So here's just kind of a bit of a simplified framework on what sort of worked and what didn't work project-wise in OZs 1.0. What worked, as already mentioned, new and refurbished, multifamily rental housing. That was probably the plurality, although likely not the majority, but plurality of OZ investments. Here we're talking about, new apartment buildings or substantially improved and renovated apartment buildings. And because of how the regulations are written, OZ investors are much more likely to be interested in the rental housing market than they are to be developing, single family homes for purchase on, shorter than the 10-year time horizons that they're required to hold their OZ investments for. So that's why it generally skews towards rental and density, and why when you're thinking about zone designations, you want to prioritize neighborhoods that are zoned for denser and more multifamily or mixed use development and investment activity, and why, as you're trying to narrow down your selections, you may want to kind of avoid census tracts that are predominantly single family homes that are owned by local residents, where OZ investors can't do much with the rules and regulations as written. OZs are good at workforce housing, as I mentioned, so at all price points, and mixed use developments. Again, often, think street level retail or a grocery store or child care center with apartments on top, or, just other commercial space that's occupied on the ground floor. OZs are also really good at adaptive reuse and historical rehabilitations. So this could be taking an old industrial facility and turning it into a food hall. It could be taking an old hotel or a disused office building and turning it into apartments. The substantial improvement threshold that and tests and requirements that Kevin mentioned means that OZs are not only designed to build new, but they're really designed to refurbish and rehabilitate significantly and kind of repurpose assets in your communities. We also see OZ investment well aligned towards constructing real estate for commercial purposes. So here, think a manufacturing plant or building, or an industrial facility, a warehouse, a data center, perhaps. OZ Capital is good at building assets and acquiring property. It's less good. We've seen less market uptake of OZ investors kind of investing in a more venture capital style model in businesses, often because venture investors, want to sell in 3 to 5 years, not necessarily hold for 10 years. And high growth companies might grow out of their OZ footprint. And then on the small business side, right, many small businesses don't necessarily want to give up an equity stake in their business, which they would have to do to get that OZ capital. However, even though we've seen less kind of direct OZ investor finance the business itself, we have seen a lot of OZ investment flow into commercial applications and the real estate and the property that businesses need to thrive. I mentioned infill development before. So moving on to some of the other categories. OZs did support, and all across the country, including in California, a large number of deeply affordable housing developments. It just often has to combine with other sources of capital, maybe LIHTC, maybe it's other federal government tools or local government tools, in order to make that capital stack work. The OZ incentives aren't really enough alone for the market itself to deliver deeply affordable housing without those extra public supports. But OZs absolutely can and do help. I think we're going to see more of that, especially rural, commercial, and industrial development, thanks to the enhanced tax incentives, enhanced rural incentives that Kevin mentioned. We've seen OZs, develop solar assets in your part of the country for sure, because again, that's property, right? That businesses own and generate revenue off of. But OZ financing can help acquire that property and site it in an opportunity zone. And the kind of CDFI, this is the traditional community development and impact sectors. They were instrumental in OZs 1.0 and in helping really impactful outcomes take root in numerous communities across the country. But because some folks in this sector and CDFIs are traditionally in the business of lending, or for other reasons, there wasn't as much kind of CDFI and impact engagement in OZs as there could have been. But I think as more information is coming out, more models and best practices about how that sector can engage with OZs and almost, be a leader and productively steward capital behind the outcomes and the projects that they're working on, closing capital gaps, sponsored by community groups, et cetera. I think we're going to see more of that in OZs 2.0. And then I think I already kind of covered most of the things in the did not work column and the different reasons why. Brian, next slide, please. Okay, a little deep dive on zone designations for you. Next slide. So we published a couple months ago this guide for local government leaders on just the OZ, the census tract designation process. And it has principles that apply to governors, to mayors, to county executives, and even community representatives who are getting engaged in this process. And a couple kind of principles I'd like to highlight. One, it's really important to set a vision. Like, how do you want OZs to help catalyze economic and community development in your jurisdiction? Do you really hope it's a tool to help alleviate the housing crunch? And have you made other plans to help OZs do that by reforming your zoning and permitting processes and making things easier to build? Or do you more hope that perhaps it's going to be an economic catalyst, and you'd like to see more investment flow towards more industrial or business use cases? In which case, there you might nominate more industrial sort of tracts. You also want to balance economic need and investment potential. That's really important because these are not guarantee zones. They are there. Once they're designated, private investors can make investments basically on autopilot as long as they're qualifying with the regulations, or they cannot invest in designated zones. They need to see attractive investment opportunities. So there's a lot of local role there. One, in nominating zones that do actually have those opportunities, they're investment ready. But then two, over the long term, making sure that you're doing your work to help pull together projects that are really meaningful for the community, but also offer private capital the return that it's going to need in order to be interested too. And then in the zone designation process, combine both quantitative and qualitative insights. Your friends at GO-Biz are, they have thousands of census tracts to look at, several hundred to nominate. They will likely primarily be doing that based on spreadsheets, right? Just because of the sheer quantity that they're dealing with. And those numbers don't necessarily tell all that much about the character, the zoning, the investment opportunities in any individual census tract, which is just a 9-digit number in that spreadsheet. So make sure you're thinking through and telling the story of why this census tract makes a compelling OZ designation, and why with the scarce number the governor has to nominate, this should be one of the few he chooses statewide. Okay, next slide, please. So building on some of those themes and just making this concrete, we recommend a 3-part test as you're going through your list of which census tracts you want to suggest to the governor. So one, start with a community test. Does this area genuinely need new investment? And is it a worthy, allocation or worthy use of taxpayer dollars to help encourage private capital to go into this neighborhood because of its distress profile or because of what it means, for the broader region? And then that market test, does it have a good chance of attracting capital within the timeline? And then policy test, especially where there are scarce allocations to go around. Have your partners in local and county government made this an investment-friendly jurisdiction where an OZ investor who has dates certain at which their money needs to be translated into investment on the ground, that they know, they can likely get this project over the finish line if they take a risk on your community, or have you made it very hard for them to be able to pull off a project on the timelines that they need, which is usually a 2-year timeline. Next slide, please. So some key questions. We won't run through all these, but I'll leave these for you later. Things to think about is really where would you like to channel development? Where maybe have you already laid the groundwork through zoning reform or through site development or prepackaging? That you've flagged, this is where we'd like economic activity to take root. It's great if you can layer an OZ nomination on top of that. You can think through, anchor assets, maybe transit corridors or transit-oriented development opportunities. All make a lot of sense. And as where there might be vacant land or brownfield sites that are ripe for economic reactivation. And on that point about land, where might the county, city, local government, or land bank authority like that actually have land that they could contribute or lease at nominal rates to high impact projects, and get a lever in the outcomes that may flow from that investment. That's a great way to kind of think ahead to how you want to follow through on these zone designations by getting actively engaged in investment prospects that come down the line. Next slide. Okay, yeah. Allegheny County, Pennsylvania has done a nice model of just kind of overlaying OZs with zoning. So you can see like, hey, this tract is actually a cemetery and a small single family home neighborhood. There's almost no chance OZ investment can go there. We'll focus our efforts elsewhere. So it's just a nice kind of good practice for down selecting your zones, which you need to do right now. Okay, next slide. No, we're short on time. DC also had a nice process that any local community can go through, just layering lots of different public, private informations in their own city plans to identify tracts that are very likely to attract investment, and that they can feel good about nominating, that they've really already been vetted by the community as kind of raising their hand and saying, yes, private capital's welcome here. Okay. Then last but not least, next slide. We can skip this one. I'm going to go to just show a couple of case studies that just want everyone to have in the back of their head, and folks can dig into more deeply on their own time. So one comes from rural Alabama. This great example of civic entrepreneurship where a local leader said, you know what, here's an OZs 1.0. Here's a capital gains tax incentive that's totally market-based and no one's really driving it. It's out there it's totally decentralized, and deep need in rural distressed Alabama. And these two things are never going to meet if no one actually forges the connective tissue between the incentive and the impacts that are needed on the ground. So it really worked, became kind of an entity that helped deliver, helped low capacity rural communities kind of package up deals that could be attractive to investors, helped cultivate a local investor base of folks who were committed to the state and doing impactful work in the state, and really kind of the definition of an ecosystem connector. And they've had really nice success through OZs largely because of this entity's work. Next slide. An example in downtown Los Angeles of how local governments can get involved down the line, where the United Way of Greater Los Angeles, the Homeless Services Authority with the city, an impact-minded real estate developer, and an impact-minded opportunity zone investor came together to create a multi-hundred unit, deeply affordable housing development to provide transitional housing for the homeless into, hopefully stable housing and stable outcomes from there, where, the OZ tax incentives and combined with the certainty and kind of purchasing power and guarantee that the Homeless Services Authority gave them to kind of complete the financing package, just was able to bring this over the finish line and have really high impact outcomes locally. Next slide, please. And another example of this is from Philadelphia, so from much farther afield, but where kind of the traditional mixed-use OZ development model combined with impact investors and community development stakeholders, was able to deliver affordable housing, and then address a medical hospital desert, a food desert, and all through this mixed-use development. Next slide. And up in Seattle, Washington, a nice example again with impact investors involved is one that was particularly notable about this, though, is where the city of Seattle, along with Grow America, which is a nonprofit that's also a CDFI, actually, purchased the retail space for a number of locally owned small businesses in this very low income, predominantly immigrant community, for them to own after the 10-year OZ Investors 10-year hold is up. So they have a kind of ownership stake in this project, and their business can have that certainty of staying and kind of growing with the community down the long haul. And I thought that was a nice example of how partnerships can form to really translate and forge that connective tissue between incoming investment and long-term impact on the ground. And I will stop there for time. Thank you.
All right. Thank you so much, Kenan. Really appreciate all that wonderful and valuable information. And really appreciate you showcasing those case studies at the end, demonstrating the types of impactful projects that the Opportunity Zone program can support. And really, I want to thank both Kevin and Kenan for those excellent presentations. I think both presentations did a wonderful job of setting the stage for the next portion of today's webinar, which is where I'll be providing a broad overview of how the state of California plans to approach the OC 2.0 selection process. And we'll also be sharing some information on how local communities can participate in that process by submitting census tract recommendations to the state. Since we're limited on time, I do want to move through this information fairly quickly. Just want to emphasize that the information we are sharing today is intended to just serve as a high-level framework for the state's upcoming selection process. Additional information will be shared in the coming weeks and over the next month through successive webinars and through our office hours. But the goal today, along with Kevin and Ken's presentation, is really to help local jurisdictions begin thinking strategically about which census tracts may be strongest candidates for Opportunity Zone designation, and then really to help communities prepare the types of information they will need to collect in advance to submit recommendations to our office. And so really wanted to begin with just a general overview of the anticipated timeline for the state's OC 2.0 selection process over the coming weeks and months. Over the next several weeks, our office will continue hosting informational webinars as well as office hours to provide continual updates about the OC 2.0 selection process. And then also these webinars, office hours are intended to support local jurisdictions and stakeholders throughout the process. So through the FAQ and the office hours, we will be available to answer any questions or inquiries that you may have. And then beginning in mid to late June, we anticipate opening the application window to begin accepting census tract recommendations from local communities. And this submission window will likely remain open through the end of July. This is to ensure that communities have sufficient time to coordinate locally and identify priority census tracts for consideration. So we will give a substantial amount of time for local jurisdictions to identify and submit recommendations to our office, but we definitely want to encourage local communities to start doing their research and start thinking strategically now about which census tracts they want to recommend. At this time, it is our intention to accept formal census tract recommendations from local government entities. So, really, any local government agency or subdivision of a local government agency will be able to formally submit census tract recommendations to our office. So, cities, counties, special districts, regional joint powers authorities, councils of governments, and similar public agencies will all be able to formally submit recommendations to our office. So if you are a local organization, an economic development organization, or community group, a developer, or just any other private stakeholder, and you're interested in recommending a census tract for OC 2.0 designation, we encourage you to coordinate directly with your local government partners to incorporate those recommendations in their submission process to our office. We do plan on setting up an online portal or a web-based submission form for local jurisdictions to submit census tract recommendations. We are still finalizing all the information that will be gathered in this web form, but at a minimum, we do anticipate requesting basic information such as the jurisdiction submitting the nomination, a point of contact, lead point of contact at the jurisdiction, the census tract number for the census tract that you want to recommend, and then likely we'll have brief responses giving local jurisdictions the ability to describe how the track aligns with the state's investment and economic development priorities. And then following the submission period, the state anticipates spending August and September evaluating and scoring the census tract recommendations. And then we expect to submit the final nominations to the U.S. Treasury, or the governor's office will submit final nominations to the U.S. Treasury before the September 28th deadline. And then we also anticipate publicly releasing the final list of nominated census tracts around that same time for public viewing. So real quick, just wanted to cover some of the criteria that the state will be evaluating when selecting census tract recommendations. And again, it's the intent of California to prioritize census tracts that align with statewide and regional economic development objectives. So things we'll be looking at are census tracts that advance the Jobs First regional plans and the statewide economic blueprint. This can be, projects, infrastructure, public works projects, economic development initiatives, activities within census tract areas that support or advance the Jobs First regional roadmaps and the statewide economic development strategy. We'll also be favoring census tracts that attract private investment into affordable housing projects that align with local regional housing needs assessments or RHNA goals. Obviously, we want to utilize the OC program to support or advance some of the state's housing objectives. So definitely residential housing projects will be a criteria that will be heavily favored. We're also going to favor census tracts that have the inclusion of a GO-Biz designated business ready site or a shovel ready site defined by the GO-Biz ready sites tool. This is essentially any parcel, land, or vacant lot that um, is, has permits secured, has secured entitlements, or really just, shovel ready and ready for ground up construction. And then finally, we're looking at favoring census tracts that have demonstrated or planned public investment within the census tract. So if there's already federal, state, local funding being directed towards those census tracts, if the census tract has an infrastructure financing district or a TIF district, Those will be strong indicators demonstrating that public investment is already occurring within a census tract and is likely to attract additional private investment. And so those are the types of criteria that we're going to look at. So this is just to give a high-level overview of the type of criteria and evaluation metrics that the state is going to prioritize. We do encourage local jurisdictions to keep these priorities in mind when determining which census tracts to recommend for state consideration. And then beyond the formal evaluation criteria, communities should also consider whether census tracts demonstrate strong potential to attract future opportunity zone investment, similar to the content that Kenan shared in his presentation. So things communities should consider include like, is there a pipeline of development projects planned within the tract? Is there ongoing business or economic development activity already occurring? And then is there potential for future job creation, infrastructure investment, housing development, or business expansion within the census tract? Ultimately, the opportunity zone incentive is driven by private investment decisions, and investors will naturally look for areas where they see strong long-term growth potential, as well as achievable project outcomes and lower investment risk. And so, communities that can demonstrate local support and has a clearer vision for economic growth will likely be in a much stronger position to attract future private capital investment and be viewed more favorably when we nominate census tracts to the U.S. Treasury. So again, I do want to reiterate that additional details regarding the submission process, the evaluation criteria, and the application procedures for recommending census tracts to our office will continue to be shared in the coming weeks and over the next month. And communities will definitely have time to gather the information needed to prepare their recommendations. However, in the meantime, we do encourage everyone on this call, all attendees, all local jurisdictions, to visit the dedicated Opportunity Zones 2.0 webpage on the GO-Biz website. And we've included a QR code with a direct link to our webpage. This webpage will serve as the central hub for future webinar announcements, as well as program updates, guidance materials. There will be links to resources by both Novogradac, EIG, and other third-party websites to help you support in your census tract identification efforts. And then, yeah, there will be additional resources related to the state's OC 2.0 process. The webpage will also include a link to the Novogradac interactive mapping tool that Kevin highlighted in his presentation. We definitely encourage you to use that tool when identifying census tracts. And then if you haven't done so already, we also encourage you to subscribe to the various GO-Biz newsletters because future announcements and updates regarding the state selection process will be distributed through those channels. So yeah, just as a reminder, today's webinar will be recorded and posted to the GO-Biz YouTube channel so that attendees can revisit the presentation or share it with colleagues who may have been unable to attend today's session. And then we will also be posting those links directly on the GO-Biz OC 2.0 webpage, along with future webinar dates. All right. So with that, I do want to sincerely thank all of you for taking the time to join us today. As a reminder, we will be hosting the second session in our webinar series next Tuesday, May 26th, same time, 10:30 to 11:30. We will be having several informative guest speakers. Larry Cosmont with Cosmont Companies will be joining us and giving an overview of how OCs can be paired with tax increment financing districts to support economic development objectives in communities. And then we will also be receiving a presentation from Ellen Chang with Capstone, who will be sharing insights on how opportunity zones can be used to support various industrial and commercial development activities. So definitely would encourage you to participate in that, and then we'll continue to share regular updates regarding the state selection process. So again, we appreciate your partnership and engagement and for joining us today, and we hope to see you on future webinar sessions. Have a good remainder of your week, everyone.